When we look at where these tariffs are hitting, for us is a big deal. That's a big first order consequence to us. We have the next problem, which is the banks. It is a compounding effect. Uncertainty, increase in prices, lower rents, it shuts that down. This has long-term consequences and effects. Some of them aren't bad. One of the things that this can really affect is the future demand for storage can really rise. So the good side of it is if you own a storage facility, right, it can really slow down that supply.
I own a facility today, let's say. What are the top things that I should be looking at and planning for as an owner-operator over the next 12 months if things stay as they are today?
Out of all the things, will have the largest impact on self-storage demand more than anything. Welcome everybody to Self-Storage Income, and today we are talking tariffs and the effect that tariffs and trade wars will have or could have on the self-storage industry.
It's a big topic, man. It's a big topic, something that can and will and does impact every industry across the United States and potentially around the world, from self-storage to banking to cars and trucks to
all of
technology, everything in between. There's so much that we import. There's so much that we export. There's huge relationships that we've got, obviously, with these countries around the world for all of these goods and services that we rely on. So it's going to be interesting to dive into this and see how we believe it is going to or is impacting the self-storage industry.
So as of right now, the situation, because it does change and it has been changing, but still the tariffs with Mexico and Canada are on. Those are the 25%. There were some exceptions given. Tariffs on China, those are still there. So as of this recording, those tariffs are still in place. Now, we should mention, it's been fairly clear that the purpose of the tariffs seem to be there's a few different purposes and why they're being used. And one of them does seem like negotiation tactics. So at the time of this recording, that's where we are. We don't know if that will necessarily change or not, but president's come out and said, nope, we're not making any changes quite yet. He's waiting to get something from Canada and Mexico and what they offered. I think as of this morning, he said it's just not enough. We're not there. So we're kind of going at this as moving forward and what this might look like one way or another.
We were just talking about it last night, really diving into how it's going to potentially affect home building, how it's going to affect people moving, buying homes, all of these different things. Again, it's going to trickle down to everybody out there that are just own a home. Yeah, we've got some stuff. You put together some great information here. Something that I hadn't thought of yet was, those individuals out there who have either bought businesses or have assets or have variable rates of any kind, and the potential inflationary aspects of the tariffs impacting interest rates and therefore keeping them high and or driving them higher. So if you got those variable interest rates, that could be potentially something that you look for. That's just one side effect that I think we'll dive into. Yeah,
there's
today.
You have like the core straight, but then you have second, third order consequences, which with tariffs, they can be big. And to be frank, we don't even know. Once you start getting into like third order consequences, we don't know how the economy will adjust or react. Some things that were even surprising to me, the stock market really went down, but then it actually recovered and we didn't see it continue. And so sometimes the third order consequences and even the second order, we don't know. Yeah. We don't know how consumers and businesses will respond. We don't know what will happen. We do know that the effects on the Canadian and the peso, their currencies, they went down dramatically. So they've been getting hit, which was interesting that the relationship wasn't the same. To me, that looked like people are saying the impact on them versus the United States is much greater. And there's concern then about that. So there's all of these second and third order consequences. We'll kind of talk about and say, there's first order consequences that are just direct. This is what that means and how that will impact. And then there are these, once again, second, if that happens, that means we could see or might. And then if that happens, right? And so it kind of is this trickle down, like you were mentioning. And so it can be complex. So we can start with the fundamentals, first order consequences, right? And that kind of leads us down that road because it's a lot. I mean, it's a big topic. And a lot of these things we are drawing from what we understand through the industry. So how customers react through our industry, how the players in the industry, like large REITs as well as large storage operators like ourselves down to mom and pop storage operators, how the mentality of that changes things. So what we interpret, we see this, if this means X, we will do that. So we know how we would react and what we would do. So we could talk about that, right? And how that will affect us and what we see. We do have a pretty big case test though, because during COVID, we saw prices go way up and that did have an effect on our industry. So we do have some test case here that we understand in some of those areas what could happen because we literally have seen it, which is interesting.
It is, yeah. You don't have to have the exact same scenario play out, right? It can just be the same kind of outcomes that you're seeing, right? So it's like, like you said, the increased cost. When we saw increased cost, what happened? Well, there wasn't a whole lot of transaction volume. Things really slowed down. And there was kind of a race to the bottom as far as the REITs were concerned. And then as far as the street rates went for rentals, all of that. So there was that dynamic going on and the revenue management, therefore, practices that we had to then implement through those times. So we do kind of have a playbook, right, of how we would react and behave in those times, because in those times, rising costs of all things, people are going to have a lot less expendable income. They're going to be buying less things. They're not going to be able to justify the expenses of having that storage facility unit hanging out, or the third or fourth one that they might have.
Yeah.
So there's a lot of those dynamics that I'm curious. This is such a huge thing to unpack. And I think like what you're talking about, a really good place to start might be just that first order in saying, again, and one of the first things that comes to mind for me is the development side.
Cost of material.
Materials going to be increasing by a same amount or not, if not more than what the tariffs are.
Because we saw in 2018, we had a 25% steel tariff that was imposed. So when that happened, steel manufacturers hiked prices about 20% overnight, right? Like it was immediate. The steel cost fluctuated between 10 to 30% higher. And that was a big, real quick thing that we saw with tariffs. So when we look at where these tariffs are hitting, steel for us is a big deal, right? Like that's a big first order consequence to us because our buildings are mostly steel. So that's like our main driver and cost. So the tariffs on steel are immediate to developing value add or buying doors for your storage unit. And we saw an incredible increase the last time that happened. And we never came down from that. I mean, when that and COVID and the overall higher prices due to supply chain, so we had tariffs and supply chain, we were building storage for twice as what we were 5 years previously. Those costs skyrocketed really, really quickly. And so that is something that I obviously think we would assume would take place. If we are going to have a direct tariff on steel that is more than what it is, that will be immediately imposed and we will get the effect. Our costs of that will rise.
Yeah, no, you're exactly right. And then, are you accounting for those increases in underwriting? That's one of the big pieces there that you're going to have to consider and plan for. I would stress test it, really look at it and say, okay, if it did increase, steel increased X amount, talk to your GCs, your contractors, whatever, and figure out what that actually looks like if that were to take place, and does the project still pencil? What are the other things that you're going to have to do? Yeah. The other thing is, you talk supply chain a little bit. The United States isn't built in a way yet that can sustain, and going back to that same time frame when those tariffs were imposed in the 2018 time frame, American industry couldn't keep up with that demand. And so we're not in a place today even where America could just be totally independent, which it's unfortunate. I wish we could be, which I think is going to be a long-term, or could be a long-term effect of tariffs and these kinds of relationships with trade and these other countries is, but I kind of wish we would have went about it a different way, just personally, my own opinion here, but let's build that infrastructure and then move more towards, independence, tariffs, all of those things, or, incrementally grow it. But I mean, going back to supply chain here, if we can't sustain the amount of demand for those materials and we can't afford to import them, what are we going to do for one? Yeah. What are builders actually going to be able to do, if anything at all? Or they're just going to have to abandon projects. Then you think about the impact that that's going to have on the banks, on the investors, everything else that are involved in those. But then you also think of how much that's going to just increase the cost, and that restricted supply and just vastly increased demand. You're going to have prices that are just will not pencil.
This has been something that we've seen, especially in third tier, fourth tier markets. Price increases went up so much, rates did not rise to justify it. And you had markets that went decade plus without building because you'll never pencil. Like, the rates in that market don't allow you to build at that cost. And what I think got a lot of people in trouble is when you were going and building, if you're under contract and you're a cost plus, whatever it may be, or two, those prices go up so much that the builder, they won't hold to them. Then you haven't ordered in, you haven't locked in that steel already, and you're in the middle of development. A 20% or a 25% increase on steel on a storage project is astronomical. That's, that you need to re-underwrite at that point. Yeah. And so if you're in the middle of it versus starting it or planning it, what I think it does is it makes, if even having a threat out there, makes people hold back on developing, because they go, if I start this, what happens if it changes? And then they may underwrite and go, it may not work if this changes, then we're not going to do it. It doesn't even need to be in place yet. And the rates, due to higher interest rates, like Connor was talking about, what we saw in demand and occupancy as it went down and rates went down, new builds all over the place started to not really pencil as well. And so then that had a huge effect on building and development too.
We had somebody right next to us developing that, shut everything down. And they're trying to sell even still today. Yeah. They haven't even offloaded. They've been for sale for over a year, probably. Mm-hmm.
Yeah, absolutely.
No, it was crazy to see a lot of those projects stall out. They had a plan to build out that whole entire property next to ours and built like a sliver of it. And that was it.
That was it. And they couldn't do anymore. Yeah. And this has long-term consequences and effects. Some of them aren't bad. One of the things that this can really affect is the future demand for storage can really rise, because the supply going on in the market now has been hit really, really hard. And we see that. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. So Marcus and Millichap came out about a 40% reduction in new build over the next 5 years. The numbers that we're looking at, we're peaking out. So we're kind of at the top of that building development cycle. And that's really gone down. And most of that has been driven because of lower rental rates and occupancy, yet we didn't get lower cost. And two, you find pockets, I guess you could say, of development. And that is only in markets that have rates that are above a certain level. And then below that, it just doesn't work. And so you will have entire markets, like class of markets, like fourth tier, you just can't build it. So the good side of until rates rise and get to that point, right? So the good side of it is if you own a storage facility, right, it can really slow down that supply, which increases demand. Now, if you're a developer, though, that is not good, obviously. So there is two sides of it. We would expect that after a contraction in rates, like we've seen, and a contraction in occupancy, that over the next 5 years, we will definitely have it swing back the other way. First of all, the natural development cycle was ending, but then that increase in costs and everything exasperates that. So you'll get higher occupancy, higher rates, more demand will come up, and then you'll kick back in the development again once rates obtain and demand get there, but they're going to have to rise because the cost of building's gone up so much. So it's not an equal trade, right? It's not like, oh, well, occupancy goes up and rates go up by 10, 20%, but building costs doubled over the last 5 years. So you have a lot of markets that rates need to over 2x to even get to a point where you'd probably even consider building. So that's like a direct impact on cost rise. Development doesn't make sense. It slows down on top of the fact that we've had lower rates, lower occupancy, development dries up, demand increases for storage over the next 4 years, 5 years, because your supply has just plummeted. And then the cycle starts up over again. But building is, the tail end of building is long. So the inventory that has been coming out of last year started before we had the contraction in occupancy and rates. Once you start, it's 3 years. So the market changed in the middle of the development, right? So once it starts, it's a 3-year cycle until it starts getting out again. So the tail end of development can be long and it can have exasperated effects on rates. And we saw this from 2008. The building that vanished, development cycle that vanished after 2008, created a lot of pent-up demand that we really started to see escalate in 15, 16. And then that made rates from 2015 to 18, 19 really go up. And then in 18, 19, we started to see the development really hit. So the direct effect has long-term effects in our building. So first order, your prices go up. Second order, it dramatically affects the supply-demand level within individual markets, but in the nation as a whole.
No, those are really good points. Kind of that first order, the trickle-down effect. Talking about another, this might be a second order, but I'm trying to think of what this would be. But do you think, like as we're talking about this, this isn't new, right? There's economic cycles, things that we go through. Business, this is business as normal, right? Business as usual. It's nothing new. We've been through it. We've navigated it. Do you see firms shifting away from development and focusing more on acquisition? Because we're in such a great acquisition environment. Even if rates stay somewhat high, we're seeing amazing deals even with rates where they're at. You've always got the creative and seller finance deals, all of those things. Do you think big and small players alike are going to shift gears a little bit due to those economic conditions to acquisitions? Is that going to make it more competitive? What are your thoughts?
The firms that we've talked to, it is just gone. They've just all development off. Firms that were development, even firms that specialized that, they started to go into other asset classes. And, I talked to, I don't know how many people that were, we had 10 locations and we're not doing any of them now. And that's common. In fact, the amount of players in the industry alone has contracted. And we've talked a little bit about that before where, I guess you would call competition firms like ours, I don't really view them as competition, but just people that do storage like we do, just evaporated.
Yeah,
Just
just gone,
like
man.
we don't even hear about them. And so that creates a second order consequence, though, of you have increased opportunity because now you have less competitors. So although less transactions or developments even too are happening, you do have more opportunity for the ones that are left because it's such a small amount. And so I think you will see a shift of focus to acquisitions because acquisitions are starting to pick up. And so the ones that are there that are in the storage game, it will move over to that side. And that's where they'll be placing capital if you can't have good development opportunities. Because the thing when you get into trade wars, economic uncertainty is bad for development. So forget about the cost.
Yeah, yeah.
The economic uncertainty alone in development kills you because that tail end is so long. So I start now, what's the world going to look like in 3 years? I don't know. Then we're not doing it. So we have the next problem, which is the banks. So banks have just gone risk off in the last year. They're pulling back, and we saw this. 2023, the end of 2023, was just for development financing. Holy cow, nightmare! I mean, nobody. It was pencils down, risk off. We're not doing this, and so the capital to actually invest in development. We also saw that through investors. Investors were just like, we don't want developments. So now, even if you have a opportunity and a developer that wants it, to find financial partners, it becomes hard. So it is a compounding effect. Uncertainty, increase in prices, lower rents, it shuts that down. But self-storage is still a hot asset. As in it, even with the last 2 years and everything, the amount of people that want to get into it, people are looking. So it's still there. It's not like it used to be where when interest in self-storage died, it completely gone. Like nobody wanted it. Nobody wanted to. No, there's private equity. People want it. So we probably will see an increased focus in the coming 2 years on acquisitions. And that will be most of the business plans and strategy. Developments will be kind of like we've always done them, where we do developments. We have architects, construction management. We do that, but it's very specific. Like it's like a specialty kind of thing. And so, I mean, we're developing, 500,000 square feet, but they're specialty projects. And you're going to see a lot more of that, I think.
Yeah, no, that totally makes sense. And the other really good takeaway, like you said, long-term wise, the really positive side of these things is that lull in development, then creating a high level of demand. So if you are able to, work through those barriers of entry now and get developments on the books, get those completed in the next 2 to 3 years, and be able to hit at the time that demand is high and supply is low, that's great.
That's been our thing. Like literally, I'm like, no, I want to develop. Like we're like, everybody's getting, like, why are you going through? Because everybody's getting out.
Yeah, dude.
And yes, we may be a little too soon in some markets or whatnot, but if it works, if the development works, right, and good, I like that. I like going into areas that already had high barriers of entry, that had these specialty things going on that we could get into. The overall lack of development, that helps us out. That helps that business plan. And I think that is a very important piece, because in development, that tail end, when you thought it was good in, 2022 or 21, you ended up when it was bad. And so then everybody gets out when it's not as good, they get back in and you're already at the end of the cycle. So because that tail end, you really can get caught. Everybody gets caught at the end of the cycle with developments. That's why we don't look at market drivers overall. Like we're like prime locations that we want to be in forever. And two, we need a margin of safety in rents. Like we won't look at anything that's $1.50 a square foot a month less. There's no reason to even look at it. And it may pencil and it may be good, but there's no buffer there. And so if you have, which we saw on each one of our developments, cost didn't kind of go up. They skyrocketed.
Oh, yeah.
And so with that, we were very fortunate how picky we were. And we were in markets where the price was so high, we could have a massive fluctuation in our cost to build, and the market could sustain it and it was okay. So you got to be more careful about that. But that also requires way more expertise. So the people that are in it are storage people. You get rid of developers that are just there to flip. And the reason being is higher interest rates, higher cost. When it comes time to sell it or flip it, you get it done. The developer wants to sell it. You're paying a higher cap rate on top of higher cost. You're barely making money, or your return's not as good. So those things just kill that development cycle. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
Another good aspect about this and a positive side is anytime there is turbulence in markets, let's say transaction volume, like it is, obviously transaction volume on home buying is down, right? But it could also be a good thing. There's a lot of people that aren't moving, but there's a lot of people that just might have to move at some point because they want to downsize. Yeah. They want to get out of the home that they're in, get into a different place, whatever it is. This is something else that we've seen in the past where, like home selling, all of that stuff, like people moving, all of that. It wasn't just this decision. It was because of something driving them to do it, and they had to do it. I think we're running into complications there where a lot of these people are locked in at super low interest rates. A lot of people don't want to move. Doesn't make a whole lot of sense for them, but
they're not going to unless they need to. Exactly. But then turbulent markets make it need to. Also turbulent markets. So you have trade wars going on. Markets are less unstable. Economic activity condenses and contracts. Then the Fed can come in and lower interest rates. We've been stuck in a cycle where government spending, interest rates were too low for too long. We had government spending that was astronomical. That created inflation. Then inflation made it so we had to raise interest rates, but interest rates went up and government spending didn't go down. It remained trillions and trillions adding to the money supply. So interest rates couldn't come down. Inflation came down, but it was, they even mentioned that they were going to reduce rates and inflation spiked back up. So it was like, they're like, we can't do anything. So, that turbulent markets, uncertainty, lack of business activity, a recession, the good side to those things, which recessions are normal and part of it. What's not normal is not having them. So the contraction in the business cycle, that allows for the cost of capital to go down. And that is good for our customers. That is really good for our customers. And people are like, well, but people are going to lose homes, so they're not going to have as much money. Well, it's true, but the effect isn't the same. It's not equal. So if unemployment went up to 6%, you have 6% of the population that we say can't afford homes, can't buy goods and services, things like that. That contracts economic activity. Absolutely, because that's compounded out. But if that allows them to lower interest rates affects everyone. Whereas you're talking about 6% versus, 94%. 94% of the still employed people, they have access now to cheaper debt. They buy homes. That kind of stuff starts moving. So there is a benefit in recessions for us in times like this. And that's that our primary constraint for our customers today is inability to move. If that is gone, demand for storage goes way up. But that can't really go away until we have an economic contraction. And I don't necessarily mean a recession by that, but we have to have economic activity slow so the Fed can get to a point where they can lower interest rates.
Yeah, no, all really good points there. I've heard some economists and folks throwing out this idea of stagflation.
Yes.
Do you think that's what's happening? Do you foresee that happening?
It
Do you
could
want to
be.
talk about what that is?
Yeah, that's very dangerous. So stagflation is there's so much money going around, but we have inflation that is created by trade wars. And so the products and services all go up like 20, 25%. And so you have rising prices, but you can't lower interest rates, right? And you have a economy that is not necessarily totally contracting. And so you have stagflation where it just stagnates. Prices can't come down. You can't lower interest rates. It's this stagnating effect. And stagflation's bad because what you do is you're put in between a rock and a hard spot where you would, in a normal economic contraction or problem where customers are getting hit and can't buy, you lower interest rates, flood the money with market, incentivize the market, expand it, issue credit into it, then people can buy and it moves up. But when you are faced with products and services that are inflating and they're getting really high, and a lot of that is not due necessarily even to the cost of money, now you can't lower it because that exasperates the problem. And so everybody's stuck. And it's a bad situation to be in. Like, it's like you took away the tools. So it's better to have a recession than it is stagflation. Like, it'd be better literally for prices to just fall and contract and everything. Recessions can generally last, 4 to 6 months or something like that, right? Stagflation can last for years.
No, that's incredible. Yeah, it's a really interesting place to be. And it's almost felt like we've kind of been there for a bit.
Yeah, it has.
Because interest rates and inflation, all that, I mean, it's stayed relatively stagnant.
Yes, it has. And it really stagnates the economy.
Yeah.
And the reason that was happening was due to government spending. So government spending was creating the situation where you couldn't lower interest rates. So what essentially we had was Main Street was like, we're not doing good. But traditionally when that happens, the economy is contracting. But the government was spending so much money, it was offsetting the shrinkage in economic activity with government borrowing and debt, pouring capital to the tune of, once again, trillions. You had COVID, yes, but after that, like $4 trillion a year being sent into the economy. Not all government debt contributes to the money supply, but the spending and the kind of debt that they were taking and spending was contributing trillions. So if the economy contracts by trillions of dollars, and then that creates job loss, that also creates a point where price, goods, and services can come down. That's a normal functioning thing. Interest rates drop, then it can start up again. But it was contracting and the government was offsetting that contraction. So the money supply wasn't shrinking.
Right.
And so you can actually look at the money supply and you can see how it went down right after interest rates went up. It started to go down and then it plateaued and leveled off. And then I made a YouTube video on this. You can see, I don't know if it's up or not, but I actually built out an entire chart that shows the money, interest rates, inflation rates, and how we just hit that point, whereas government spending just kept going. That was higher than anything we'd seen previously. It shows like the years. You're talking trillions. It creates stagflation. And that's the thing with stagflation. It is not a normal thing. So goods and services aren't being driven by economic activity. Like, so tariffs cause stagflation because it's not demand that's driving prices up. It's the government that's driving prices up. That's same with government spending. It's not demand that's keeping the money supply growing. It's not debt. It's not that everybody's just making more money and feeling better. It's the government that's doing it. So it's an artificial situation which doesn't allow capital and the cost of capital to move through the economy in a normal way.
Yeah. Interesting times, man. It's like we've said, we've seen a lot of these similar dynamics in the past. I haven't seen a situation like this in my lifetime, lived through it, but obviously you've seen certain circumstances like it take place, and a lot of our plans and coordination that we're going to do moving forward will be based on, just what we know and what we've done in the past. But that is one of the benefits of self-storage, man, is the fact that a lot of that turbulence does lend to its consistency over time. And it makes me think too, like I own a facility today, let's say, what are the top things that I should be looking at and planning for as an owner-operator over the next 12 months if things stay as they are today?
So we have a few things. So you have storage, but then you have the customers, right? If you're not planning on building, some of these things won't really affect you as much. So still going up, where it'll affect you is the cost of replacement. So your CapEx will rise, right? Now, for the most part though, that hopefully won't be a lot. And if it is a lot, it's due to something, bad, and that's an insurance claim. And so hopefully that will, but it still will be. You need to replace something that you will have the cost to go up. Really where I think the biggest focus will be is on your customers. And this is going to be much more geographic centered. So when tariffs rise like this, you have production and trade, and you have like main areas of it. So you have like ports, right? And you have cities on the border that this is how these cities function and thrive, right? So you will see you have industries that are based out of certain places, and the tariffs will hurt certain industries and businesses, right? And it'll shift. It essentially shifts the way we're doing things. Now, on the other side, it actually makes other things grow, which is weird sounding, but it's true. I mean, this was one of the large plays that we did on a development because the government, due to competition internationally, was like, we need to make production here, and they subsidized. And so that started to get built out. So in some areas, you can be in cities where they're like, we're going to invest $1 billion into this plant to grow it. So Boise, Phoenix had this, where it was an economic boost because that industry was coming there. But you will have an overall hit in a slowdown of economic activity, which can hit purchases. And so if you have like big units, you can have a situation where people are like, I'm going to sell my boat, my RV. Yep. I'm not purchasing new ones, right? And so you'll have those. And then you're going to have cities and regions that will hit harder if the means of production from that location is a heavily tariffed item, and so demand goes down. So as an operator, I'm looking at my customers. First of all, in my area, my market, and saying, what is that? I'm looking at my products, and if I have larger units that are specialty to boat and RVs, and that's going to plummet, I need to be prepared for that. But then I'm also looking to say, is it the other side where we're in a market that's getting that investment? It's going to grow. It actually helps. And am I in a market that hasn't had new inventory, and we're not going to get new inventory now? And so demand is going to grow and help. So it's much more specific right now. And tariffs will be. The impact will be broad in the cost increases on certain products and services, but they will be localized in the impact of overall employment, everything else. You're going to see way more of that.
One of the reasons I wanted to ask this, because I wanted to outline this thing specifically. We talk about it all the time, but all of the things that you just said are exactly the same things that we look at and that we're managing, regardless of what's happening.
Yes.
It's always the same.
You should be.
You're looking for a growing market. You're looking for runways. You're looking for that margin of stupidity, like you like to call it. You're looking for all of the same dynamics, whether you're investing or running a facility, looking for facilities
treating it
to
like
buy.
a business.
Yes.
Not just a asset that you hope the market will go up.
Yep.
And so understanding that customer, that product type, that match, that local market, what drives it, those are going to be important and really important associated with tariffs because they are so specific. And so generally speaking, so we know tariffs are inflationary. We know that it can have impacts on bringing industry back. But the problem is it is not a trade-off like that. Meaning, like you were mentioning, the infrastructure doesn't exist.
Right.
You have to build it. So just like development is a tail, that's the same type of thing, the same effect. I think that most of the tariffs will not only be changed, they'll probably go away. Some won't. like on China. I don't think will. So tariffs can be used as like, we're trying to get something from you, but then they can be used as I'm attacking you. And Mexico and Canada, there is an ask. We want something. Come and bring something to the table and we'll do it, right? It's that's what's going on. China, it was like, they're like, okay, well, what do you want? Nothing. It's literally, I'm just hammering you. And there's a reason why. The reason why is you are our economic enemy and we are the consumer of the world. So it doesn't matter, not only for us. If you do business in manufacturing or selling products or whatever it is, and you are in Australia, but you're servicing America because everybody services America. And so all of a sudden now it will change your behaviors. Businesses will shift out of China and they will go to other places like the Philippines, like Mexico. So that kind of attack is an attack like, I'm going to shrink your economy, which immediately, literally the next day, China came out and said their deficit numbers due to it went up, the largest they've had, and their GDP expectations shrunk down to like 5, which is very low. It's the lowest they've had in like 20 plus years. And it's principally due to the tariffs. So when we look at that, understanding too, why? Because that will tell you what's going to get hit. If you have a business, so where does your steel come from, right? Like if all our steel comes from China, I don't expect that to go away. Like that's not going to change it. But if it's maybe Canada, I do think that will change. And that will affect where you are. If you are down on the southern border or on the northern border, right? Or if your city is really fueled from trade with China, right? Those short-term things will be impactful. And now, once again, storage is micro, right? It is a 3-5 mile radius, but these things affect the micro. That's why it's important, and they don't affect it equally. So be very cognizant of what's going on in your market to your customers. That will shape and affect your demand, right? Probably the best thing though for storage operators in the long term is a condensed supply. That in 5 years, we are so short storage that rates are high and occupancy is high because that building cycle was really hit hard.
Yeah, no, there's going to be a lot of opportunity. I mean, whether you're developing self-storage or residential, multifamily, any of it, since it's going to have such a widespread hit.
Yes.
Yeah.
And
it's good
the
info.
other thing of that is the second order or third order would be interest rates. If the trade war creates a recession, we could be in a spot where we could actually see interest rates be able to go down. Out of all the things, interest rates will have the largest impact on self-storage demand more than anything, because that will change the housing market. So it would be, we saw a 20% increase in refi applications, whatever it was 3 days ago, because interest rates went down a little. 20%. Think about if interest rates went down, to 5%.
It'd be gangbusters.
It would be, the short term would just blow up. People would be moving, trading houses. It would be wild. Like self-storage demand would skyrocket.
Yeah.
And so that is a big thing that we look out for. Interest rates are lowering right now. So not massively, but they are trending downward. That does look to me, because I don't think the trade war is ending, they'll continue downwards. And I think that we may even get a 10-year and we may hit, 4. So on the Fed side, not our side. But when you look at those interest rates going down into the spring, we could have pretty big boost in self-storage for the spring months. And once again, simply due to interest rates going down 100 basis points.
Right. No, it's huge, man. All those little things. It's easy to talk about these little percentage points, but it really makes a huge difference.
And we'll keep you updated all along the way, guys, on where tariffs end up, where they're affecting steel, And so you guys know, in a changing landscape.
Exactly right, guys. Stay tuned. Thanks for joining.